Anyone can. Hi, can anyone hear me okay?
Thank you for waiting and your patience. My name is Chris DaCosta, and I'm one of the analysts at the CAISO desk. With me is my colleague Ross Fessenden. Today we'll recap the winter of 2012 and 2013. Then we'll move forward into seasonal demand, some of the temperature and precip anomalies that we've seen over the previous couple of years, and then lead into the implications for Pacific Northwest and California hydro. Following that, we'll go over the supply stack that we're expecting to see in California this winter, some of the new monitored Genscape units, as well as the growth in renewables seen throughout 2013. And finally, we'll go over some congestion, the 2012 to 13 historical constraints, some of the major changes that have been made to the market, especially this past fall, and then their pricing and congestion impacts. My colleague Ross will step in and look at the demand.
Thanks, Chris. So to begin, let's take a look back at the winter of 2012-2013 to get an idea of where it ranks historically and potentially what we can look to gain for looking ahead to this winter. So before you have two tables, one showing historical winter demand peaks in megawatts and the other one showing the date of these historical demand peaks. As you can see, 4 of the previous 5 years, the peak winter CAISO demand has occurred in December, in the month of December. This year, potentially making it 5 and 6 years, as we've seen quite a strong peak in demand early on in the month of December. Last winter was the second lowest peak demand of the previous 5, and additionally, you can see that SE does have the ability to peak above PG&E in the winter months, but it has not happened since January of 2009. Now looking at December of 2013 so far, to the left you see a plot showing departure from normal temperatures in degrees Fahrenheit for the week of 12/4 to 12/10 in December. And we saw this coincide with the 3rd highest peak in winter demand since 2009-2010, coming in at 33.44 gigs. A vast majority of the western U.S. saw temperatures fall well below normal, the exception being a small area in south central New Mexico. Some areas fell as much as 20 degrees below their norm. Even 25 wasn't unheard of. And as stated, this stretch, this Arctic outbreak actually corresponds nicely with previous year's peaks falling in the time frame of December 8th to December 19th in the previous four winter seasons. Now we'll take a look at some of the specifics of the climatology. The top 2 plots show regions of Southern California and Northern California with a monthly breakdown of their departures from average. The 2 below them show an aggregate, so the average of the winter season from last year. And I really want to call your attention to the fact that Southern California grew increasingly cold and dry as the winter wore on, with February having departures from average of nearly 2 degrees and precipitation deficits of 2 3/4 inches. Additionally, Southern California saw February come in as the 16th driest in the climatology, dating back to 1895, and had the 30th most heating degree days over the same time span. Directing your attention to Northern California, you can see it began wet and quickly turned dry as December saw temperatures about a half degree above average and 5 inches above average for precipitation. And it made a quick turnaround as we saw January and February come in with the 6th and the 4th driest January and February respectively in the climatology since 1895. And when you look at the aggregate, it comes in as the 27th driest, but that's because the early season above average warmth and moisture helped mask some of the near record conditions observed in January and February. This is a graphical representation of what was depicted in the last 2 tables, or last 4 tables rather. As you can see, the peak cold really occurred throughout the West in the month of January, and it eased off a bit moving into February in the Northwest, but still held on strong through the month of February in the southern half of the West. Now we're moving into our Genscape winter temperature forecast, and this is an aggregate for the months of December, January, and February, stretching from 2013 into 2014. And as you can see, granted this may be hard to believe given recent conditions, we do expect above normal conditions of 1 to 2 degrees milder than average in the Pacific Northwest, keeping the cold confined to the eastern 2/3 of the U.S. Extreme Northern California will stand the best chance for aboves, but largely expects normal temperatures to prevail for the main population centers. This slide shows a monthly breakdown of the previous plot with December at left and February at right. And the take-home message here is that, again, the population centers will remain near normal until February, and at that point you can expect a widespread area of above to much above normal temperatures to take hold in the western U.S. Now looking and turning our attention towards precipitation climatology, this similarly shows that after a moist start, as described earlier, with some exceptionally moist conditions in December, quickly became dry with parts of California experiencing record drought. That being said, we'll take a look at how the drought status changed from the start of last winter season to the finish of it. And what you see are the 2 drought updates from the CPC heading into the winter and coming out of the winter last season. And we saw dry conditions spread to encompass all of California as the update heading into the winter saw about 7% of California not being in what they deemed dry conditions, whereas at the close of winter last season, you saw nearly all of the state encompassed in what they deemed dry. And despite the increase in the breadth of these dry conditions, areas considered to be in drought by the CPC actually decreased. Now looking at our winter precip forecast, this again is for the months aggregated of December, January, and February. Dry conditions do look to persist in the southern half of California. This leads to the continued potential for ongoing or worsening of current drought conditions. So breaking it down on a monthly basis, we have December at left, February at right. A dry start throughout California in the months of December and January gives way to a moist February, exceptionally dry conditions persisting in December and January, with a look for some relief occurring in February. And we can expect warmer February temps coupled with higher February precip could have early runoff implications. Now to take a look at how the CPC feels, we can see that their expectations fall nicely in line with ours as they anticipate broad persistence or worsening of drought throughout California, with extreme northern and western sections of the state potentially seeing improvement or removal of current drought conditions. And with that, I'm going to pass it back to Chris, and he's going to take us into a look at California hydro.
Now zooming in onto what Ross was talking about as far as the ongoing drought situation. The chart at the left shows some of the major CDWR reservoirs as of December 1st. And you can see that reservoirs are both much lower in terms of historical averages than what we had expected. Now zooming in on Shasta specifically, they are barely above the dry year of 1976 to 77 at 61% of the historical average, and Oroville storage is significantly below that dry year of 1976 to 77. So we do expect these really low reservoirs to have an impact on California hydro generation. And just taking a quick look at the graph to the left, you're seeing the current observed flow forecast as of early December. And we're not really seeing any uptick in flow, which we usually see as a result of the rainy season in California. So there doesn't really seem to be much relief in sight as far as increasing the amount of water in these reservoirs. Now this takes us into what the impact on actual California hydro generation is going to be. And looking at this chart, it's relatively clear that 2011 was a strong hydro year. In fact, about 14% of California load between December and February was met by hydro. And while that is the case, the rest of the year, specifically spring and through the summer, remained dry. So that led to a relatively, and so that leads to, when you get into 2012, a more normal water year. Now, looking at 2012 specifically, going into the winter of 2013, things picked up considerably, specifically December of 2012. And this is the result of the Pineapple Express we saw that year that led to very, very strong rains, specifically across the middle portion of December. And I remember it led to rain of about 10 inches over a couple of days in Southern California, resulting in some flooding. But this did increase the hydro situation in California for the better across that early part of last winter. However, as Ross alluded to, the rest of the year remained very dry. And so when you look at 2012 into 2013, you see 2013 is above the prior year, but then as soon as we hit April, the dry winter months led to a very strong deviation, such that we entered this winter with much below. Now taking a look at the Northwest hydro situation, walking you through this chart, the solid red line is actuals from last year, with the dotted red line being the 5-year max and the dotted purple being the 5-year min. You'll notice that early last December, the 5-year max and the actuals are virtually the same. And again, that is because the same Pineapple Express system seen raising California hydro levels strongly impacted the Northwest as well. Now, looking at the black line here, that is the Genscape forecast for 2013 to 14, that winter year. And we are seeing relatively average flows to be expected, which corresponds with what last year we saw in the Northwest from the end of January onward. Now, as far as Northwest hydro impacts on California, looking at 2011 and 2013, over 8.5% of California load was met with Northwest imports. And the reasons are pretty similar to California reasons. 2011 was a wet year in the Northwest as well. So there were very strong flows on knob and packy throughout that winter. And again, in 2013, December of last year, 2012 December, we saw that Pineapple Express increase the hydro situation in the Northwest, leading to a sharp surge in hydro output. And additionally, we saw a lot of growth in BPA wind generation. So there was a lot more renewable resources able to flow downward into California along packy and knob. Now, given our current expectations for BPA hydro, we would expect flows down knob and packy to serve about 6.5% of California load, with the majority of that occurring in the February timeframe as the hydro situation picks up. Now, looking at another variable resource, California wind. Here, the bottom three plots contain the capacity factors for California wind for January, February, and December. You'll notice they're considerably lower than capacity factors for the rest of the year, specifically June. I included a June capacity factor plot on the same chart just to give you a sense of how that stacks up shape-wise with winter wind. And you'll notice that as opposed to being flat, the wind has a very diurnal shape. Now, California wind capacity has increased significantly over the past couple of years. We're now at 5.9 gigs. But unlike the summer months, winter wind is driven primarily by storm activity. So you could see very large fluctuations and pretty irregular output through that time period. And so that leads into our next discussion, which Ross is going to take over about solar.
So looking at the plot on this page, you see total California solar generation, combined photovoltaic and concentrated solar, dating back to January of 2012. And the startling feature that's apparent in this is that the rate of increase in solar capacity has actually masked the seasonal component that one would expect to see. So in 2012, you actually saw the first half of the year occur fairly normal to what one would expect, with solar generation increasing gradually into the summer months, with the peak for solar generation typically falling close to the summer solstice, late June, early July. And instead what we saw was the peak for 2012 in solar generation actually occurred in the month of December, indicative of the significant buildup in solar capacity throughout California. And this buildup has not slowed down heading into 2013, so much so that the peak actually occurred in September at over 2.8 gigs. And if you break this down to annual generation and average monthly generation, we're nearly tripled the average monthly generation in megawatt hours for solar generation in 2013 versus 2012, and this is not including data for the month of December, so we would expect those numbers to continue to increase. This plot shows average hourly solar generation by month for our expectations looking ahead to December, January, and February. And as I alluded to with the summer peak, you would expect solar generation to bottom out in the month of December or near late December, coinciding with the winter solstice. And as you can see, that's confirmed by our expectations for solar gen, with December showing the least amount of generation. January shows a slight increase over that, with February starting to come out of the winter months, seeing an increase in solar activity and therefore solar generation. We do see an upside risk to this as buildup in capacity is expected to continue. Now to cover all of new generation that we've seen thus far in Q2 and Q3 of 2013. You can see thermal listed at the top and solar listed at the bottom of the page. And just want to point out a couple of the larger units. El Segundo power was added, as well as Marsh Landing. And El Segundo is actually a newly monitored Genscape unit in the month of December, with March landing also in the queue to become monitored early in 2014. This plot shows solar generation by month, typically for solar and wind based on our expectations. And one of the things to take away from these graphics is that whereas in the summer months you see solar act in a complementary fashion to wind generation so that you have a relatively flat day when it comes to renewable resources, when you look at the winter months, you see a vastly different shape where solar acts to provide the bulk of that shape as wind generation remains flat throughout the course of a day. And with that, I'm going to pass it back to Chris to discuss some of the historical winter prices that we've seen in the past.
All right. In these two charts, we have the prices for NP, SP, and Mid-C in the top chart for the past 4 years. One of the immediate things that jumps out are how high prices were in 2010 relative to the subsequent 3 years. And there's a simple explanation for that. In 2010, gas prices were about 35% higher than they were last year. And the bottom chart, which shows the heat rates for NP and SP, confirms this. 2011, looking at heat rates, was also significantly lower than either of the subsequent years and the previous year. And again, this is due to the fact that there was a lot of hydro that year, which was relatively cheap, and it served a large portion of load. Now in January 2012, songs came offline, never to return. And this accounts for the increase in heat rates for 2012. Now looking at 2013, there's a pretty significant jump in prices, heat rates, and in SP LMPs relative to NP. Now looking at specifically heat rates, in 2013, California introduced the carbon market, which increased California prices across the board. And the California Department of Market Monitoring estimates that this led to an increase of about $6.15 per megawatt hour last winter, and which has been confirmed with some of our pricing. Now, another takeaway from 2013 is just the sudden increase in SP pricing relative to NP. SP had been relatively in line with NP for the previous 3 years, with NP more often than not slightly higher, but there was a pretty significant change last year. Now, two of the major differences had to do with the increasing enforcement of SEPCT and some of the effects that the new carbon market had on this constraint. It looks like the carbon adder that the new carbon market made it more expensive for certain units in the South to operate. It definitely increased uncertainty in the market as far as some of the responsibilities for the operators, and it seems to have led to a sharp increase in SEPCT. In 2012, the first quarter, there was about 4.6% of hours which were congested as a result of SEPCT. Now, moving into Q1 of 2013, there was an astounding 71.2% of congested hours. Now, the bottom chart shows output from Inland Empire as monitored by our sensors, and you can see a very, very sharp decrease in output in 2013 from January through March relative to 2012. And it looks like this was most likely due to the fact that the new carbon market made it very hard to price Inland Empire. It seems to be they weren't really sure how to bid that unit in. Neither of units 1 or 2 were on outage at this time, but it is a relatively new unit, very efficient. So it's a bit shocking to see it not bidding into the market. But this kind of bidding strategy has continued throughout 2013. Now, moving forward into a bit more congestion, 2012 to 13, SCE PCT was by far the largest congestion factor for the market overall, which led to a very strong premium in SP. The next most frequent constraint was the Barr-Lewis nomogram, comprised of 2 lines. Now, 2012 or 2013 to 2014 winter is going to look very different. In October, CAISO deemed it no longer necessary to enforce the SCE-PCT branch group, completely eliminating the large premium SP was seeing. Additionally, they unenforced the San Diego percent branch group as well, which happened in November 15th, which leads to a slightly lower price in PG&E overall, but the factor that this has on hub pricing was much less than SCE-PCT. Now, the expectation this winter is for SP and MP pricing to converge as it has previous winters. There does remain a risk of Barr-Lewis congestion since the main driver, the SONGS outage, is now permanent. And there is an additional risk of skip congestion as SCE-PCT is no longer being enforced. This makes it much more likely that imports are going to be serving some of the generation needs of Southern California during specifically lower load times when pricing drops considerably. But this should have a much lower impact than the SCE-PCT branch group has up until now. Now, just take a quick look at December this year. We have just gone through a very cold period. This chart here shows PG&E. The blue line are day-ahead schedules. The red line is the constraint during that time period, and the orange line is the Genscape real-time monitor. On December 3rd to December 4th, while there was still a 3 gig D rate on past 15, temperatures began to decrease in California, with the Northwest showing a much more rapid decrease in temperatures that began on 12/3. This resulted in packy flows to drop significantly day over day to the point where there was about a gig fewer flows on packy beginning, I believe, on Monday of that day. And so looking at real-time LMPs for December 3rd and 4th, NP pricing averaged about $85, whereas SP averaged about $45, which was a very strong premium to NP, and this is entirely due to past 15 congestion. And during this time period, PG&E load in the real-time market was about 1,300 megawatts stronger than day-ahead schedules, which resulted in a very big differential as far as flows on past 15 are concerned. Now moving forward a couple of days to the 10th, which I believe was yesterday, that was the peak, or the second day of the peak cold, but it does coincide with some of the strongest demand we've seen so far this year. The demand was so strong to the point where there was very strong increase in SCE Citygate pricing and PG&E Citygate pricing. But there was a very large premium for SCE Citygate of just under $1.30. This means that it was much more economic for units in the north of the state and in the northwest to supply the entire state with power, which drastically increased flows on Path 26 that day. Now moving to the real-time market, packy flows were about a gig stronger day over day, leading to very strong congestion on Path 26 to start the day, and an overall premium of about $20 in NP. Now these conditions are relatively rare. The Citygate price for both SE and PG&E were actually the strongest we've seen since MRTU begins, but it is something to keep in mind as how this market reacts with subsequent Arctic fronts. Now to summarize, there was a relatively cold start this December, and this should give way to normal temperatures by February throughout California. We do expect the 2-year drought to be prolonged to start the winter with potential relief in February, but this does mean that there should be less load in California being met by hydro from either the Northwest or California, and so heat rates in the state are expected to be higher to start the year. And the additional wind build-out seen this year should have a less impact for winter relative to the rest of the year as a result of very low capacity factors. But the large build-out in solar continues to have an impact, especially during the front half of the day. Additionally, there has been over 4.5 gigs of generation added since the start of Q2. Much of this is efficient, but it's primarily meant to respond to some of the fluctuations in the large renewable build-out. And finally, the large premium that we've seen in SP last year is expected to be completely gone as SE PCT is no longer a factor. But there does remain some risk, primarily the SKIT branch group, as a result of less generation having incentive to be on in Southern California. Thank you for attending the CAISO webinar, Winter Outlook. If you can, please fill out this short survey following the conclusion so that we can continue improving future webinars. Now, before we get to that, we're going to take a look at some questions that you might have had. All right, I have a question regarding the recent colds. Do you think the recent cold snap will prove to be the peak demand for this winter? I'll let my colleague Ross answer that since he looks more into demand.
So in the 9 to 12 day period, we do see a risk for another Arctic outbreak. Temperatures may approach or exceed those recently seen, but proximity to the holiday, the Christmas holiday, will make a similar response in demand that we saw in this most recent Arctic outbreak hard to achieve.
All right, that wraps up the CAISO Winter Outlook. If you guys have any questions after this presentation, feel free to send us an email. We will be sending out copies of the PowerPoint. Again, can you please fill out the survey following the webinar so that we can improve future webinars? Thanks, have a great day.